Markets are bracing for a pivotal week ahead. Joining us to break it all down is Chris Weston from Pepperstone. Chris, it's good to see you. We've seen investors selling out of core holdings, I should say, especially AI. Take us through what we're seeing.
Well, I think that may change. I think obviously what we've seen recently is just this kind of this people searching out bad news in markets and finding a little bit of it. I think we've seen people pre-positioning ahead of Nvidia's results in the aftermarket in the session ahead. Obviously, we've got payrolls coming out on Thursday as well, and I think there's just people talk about valuations. People have been talking about valuations for 18 months, but I think the elastic band had been pulled a little bit too far. There was just an absence of good news. I think people have now just looked to lock in some performance in some of the parts of the market which have done very well for most of 2025. So, obviously that's the AI winners, quantum computing, retail trader favourites, Mag 7, all those kind of areas of the market, the high growth, high beta plays. People have just taken a bit off the top, and we've seen some decent drawdown coming through in those. So the question now is now we've got a slightly cleaner position from very extended long positions. We'll have to see the reaction in Nvidia's numbers in the aftermarket in the session ahead, as I say. But the bar is still raised for that stock. But I think people have just taken a bit off the top, and that's where we've been in terms of the equity market move. People have been looking to hedge out some of that exposure as well, and we've seen the VIX trading up now to sort of near 25%. So I think people have hedged themselves a little bit for volatility. Position has come out. Does that mean now we're going to have a slightly cleaner position for another leg higher? Obviously, the price will tell us that situation, but it's really been about locking in some performance and selling out some of those winners recently.
Okay, so is this rotation simply profit taking, or does it point to deeper concerns about market leadership, if we can turn our attention there for a minute?
Yeah, I mean, I think the concentration of breadth has been something that people have been flagging. That doesn't mean the index can't rally in that situation. We saw that in 2024 where we saw very, very concentrated leadership in the very high market cap stocks, and the markets, the index still rallied quite strongly. And it was when DeepSeek hit in February and March that things came under pressure and that leadership get called into question. I think this time around, people are looking at the AI trade at the moment. It's done very well for so long. People are obviously looking at data center build out. The idea about this electrical power deficit by 2028. People are talking about the return on the investment that's going to be coming from the data center build out and agentic AI and the rollout of those situation. And I think that's just sort of right now, just taking a bit off the top, as I say. And Nvidia has pulled back about 16% or 15% or so from those recent highs. The AI winners. One of the sectors or sort of thematics that we've really liked has been AI power generation, which I think continues to be a massive theme going forward. It will be a huge political debate next year going into the midterms, as well as things like affordability. But so I really just put this down to profit taking, to be honest. I mean, just to answer your question, I think nothing really has fundamentally changed. But I think when you've seen such a run, eventually people will call into question the longer term objectives of this situation, which I still think are very, very, very positive indeed. But whether we're in a bubble, maybe we are, but that's not going to really hit home for some time. But I just put this down to profit taking from very, very extended and very crowded positioning at the moment.
Okay, so are you seeing particular sectors or maybe themes attracting that capital as the tech trade starts to cool off?
I don't think it's going to cool off. I mean, this is still the biggest thing in markets, right? I think if you look at the level of capex that the hyperscalers are committing to, you are looking at some people looking at the debt markets and the credit markets much more closely at the moment. There has been a really clear shift in the way that Microsoft, Amazon, Google, Meta, companies like Oracle and CoreWeave have approached the situation and changed this, moving away from using their free cash flow to build out the infrastructure, and now going into the debt markets. And I think that's really going to be a big theme for me next year, which is the idea that we're going to see far more of this. We're going to see huge amounts of corporate issuance from the investment grade side of things, and that's going to be competing next year with increased government bond issuance. So given that there's a finite pool of capital without the Fed and other central banks conducting quantitative easing, I think that's going to be one of the big themes next year is funding the infrastructure build out, the data center rollout, and obviously, as I say, competing with increased government issuance from the Treasury Department in the US, from Germany, and from some of the European and UK central bank governments as well. So that's one. But I think, obviously, people are talking about massive infrastructure build out in data centers, which is, as we know, is hugely power intensive. And people are talking about electricity prices, how the deficit that's going to come through, clean energy as well. So I like power. I do like the infrastructure side, the picks and shovels around data centers. I like the power generation side of things, and I think that's going to be a continued theme going forward. But I still think that investors want growth, right? They want very, very strong earnings growth and revenue growth, of course, and margin expansion. And that really comes from the AI side of things. So I think a further pullback in these names, I think will be very well supported. But right now, I think there's still a lot of uncertainty about. I say uncertainty. I think people are really looking at the idea about the returns, and I think that's just causing a bit of panic. But the debt markets are really where we're looking at the moment.
In your view, what's the most important metric or commentary investors should perhaps hone in on, given the 2025 year is coming to an end?
Where do I start with that one? I mean, we can approach that. So just staying on the AI thematic. I mean, I think, one of the things we're looking at, certainly from names like Salesforce, the companies that are using agentic AI, going into the hyperscale as well. I think you've got to be looking at the productivity side of things. So we're looking at revenue per employee. I think is a really key metric, because that's what we're talking about. If you want to look at the idea about companies getting a return, well, it's around productivity, I think, so you've got to be looking at revenue per employee. I think that's a really key metric coming through. In the debt markets, especially if we're looking at that rollout of increased corporate debt issuance through this year and into next year, well, you've got to be looking at a company's debt to cash flow ratio. I think that's really key, or debt to EBITDA ratio. I think that's where we're going to see the stress on things like credit default swaps and bits and pieces. Going into the economic side of things for next year, obviously it's the labour market in the US. I think you've got to focus on the US. I think that continues to be where we're looking at. Obviously, we're looking at non-farm payrolls numbers and the break-even rates for those next year to keep the unemployment rate fairly steady is probably around sort of 25,000 jobs per month. I think it's far lower now. So I think that's a really big one for market risk. And obviously the most central point for me when I'm trading, there's nothing more important to me than realized volatility. The volatility in the market, for me, sets everything off. It's what options markets are priced off in terms of the implied volatility. It's what, you've got these pension funds, insurance funds who are, setting their level of capital relative to the standard deviation or volatility in a market. And that, higher volatility means they take cash out of the market. It affects our time in front of the screen, hold position times, the whole factor. So realized volatility continues to be essential in the world. And as a trader, hopefully we get a slightly higher move in volatility. That's kind of what I like at the moment.
Yeah, 100%. Chris, I want to thank you for joining us on the program. Before I let you go, can I get a quick comment on Bitcoin? It's been sliding. Do you think there's more downside ahead for the crypto traders out there?
I'm long. I think we're going to get a bit of a bounce here. I'm very happy to take the loss very, very quickly on a move back below 90,000. But I think we'd probably see. I think we're expecting a little bit of a push. Maybe I would be expecting a move back into the high 90s, into 100,000 before maybe we roll over again. But we've had a 29% drawdown from the recent highs. There's been a massive flush out of liquidity in the ETF scene, positioning on the long side. If you look at short leverage positions in the exchanges, massively stacked. So if it pushes higher, you're going to see a lot of those squeezed, and that will push the market higher. You look at strategy, MSTR. The monthly net asset value now is at 1, so that's pretty much an indicative sign that things have got too far and things are now.
And they'll have to correct now. Yeah, Chris, absolutely. It's all the time I've got for you for the moment, but I wanted to thank you for joining us on the program today.
Good on you, mate. Thank you for the chat.
Right back at you.